Hello and welcome to the September SIA Wealth Management September 23 Market Outlook. My name is Colin Szynski. I'm Portfolio Manager and Chief Market Strategist with SIA Wealth Management, and I will be presenting today on what's been happening in global markets. There's been a lot of changes in market action over the course of the summer and in capital flows, and when we've seen some things accelerate as we've moved further into September. So there's a few topics that we're going to highlight here. We're going to look at inflation and interest rates and what this means for global markets. We're going to look at seasonality. Sector performance and capital rotation, the relative performance of equity markets, and a resurgence in energy prices. So the first thing we're looking at is the interest rate cycle. Yesterday was the Fed, and at the Fed meeting they paused. But what was interesting this week was also the Swiss National Bank, who's down on the bottom line of this chart, as well as the Bank of England, who's the orange line, also paused this week. In addition, we have seen the Reserve Bank of Australia and the Bank of Canada hold rates this meeting. So every major central bank this month who had the opportunity to raise interest rates, including the most recent two, the Swiss and the English, who were expected to raise rates, nobody has raised rates this month. Everybody has been on hold. Everybody has paused pretty much. Even the Europeans have started to talk about potentially pausing. What we've seen with some of the recent market weakness and an increase in treasury yields and in the US dollar is more that the Fed has, it was kind of a hawkish hold where they left the door open to hikes. They may not cut as fast as people think. And we'll speak to that a little bit more in a few minutes. But the reason for the hawkish hold was that although inflation has been coming down, the declines in inflation have slowed a little bit. And it shows here in the US Fed funds versus inflation measures. The yellow line shows how the Fed funds has not only closed the gap with inflation over the last year, but it now exceeds it. Fed funds is higher than inflation, which means that real interest rates are positive, and this is tightening. But what we've seen, though, is that wage inflation, the gray line, orange inflation, the core PCE reading that the Fed likes to use, they've kind of gone down, but they've been going down slower than perhaps the central bank would like. And even the consumer price index, the blue line, has started to tick back upwards a little bit. So this has been kind of told the Fed and the other central banks that, yes, the worst of inflation has probably passed, but you haven't defeated it completely, and you have to be careful because inflation could still come back. And this slide is showing it, and I think this is what is really starting to spook the central banks, is auto workers have gone out on strike. They want wage increases. They've fallen behind inflation for years, and they're seeing CEOs getting huge payouts and wanting to see things. We're seeing Hyundai Motors in South Korea accepted a 12% wage hike deal. Airlines, particularly American Airlines. Airlines had probably one of the best summers on record in terms of travel demand. Anybody who's been through an airport or a hotel, I think would agree that this summer has all the pent-up demand for travel came out this summer, and everybody was on the road and going somewhere, it seemed like, and places were overrun with tourists and all. And yet, American Airlines, Delta Airlines, and a few other airlines put out profit warnings because their fuel costs have gone up, their labor costs have gone up. And that's an issue because we saw with the consumer price index previously here, it goes up and down relatively quickly. Wages don't go up, don't go down quite as fast. They're what we call sticky. And if we start seeing big wage demands, that can prop up inflation for longer. That's the one that central bank's goal had been to get inflation back down before wage inflation kicks in, and it's getting pretty dicey for them. Also, food prices. We note recently in the news, Canada has been talking about, called in all the grocers to talk about what to do about high food prices, because that's another one that has been building into inflation, and higher food prices, higher energy prices, and people are demanding higher wages. And it becomes a vicious cycle that the central banks are really trying to break and avoid. At the same time, though, something that was interesting that I saw based on a few reports from FactSet recently was that in the last round of quarterly earnings, the talk of inflation, the talk of recession has dropped off. And there has been a sense that maybe the central banks have been able to engineer a soft landing and mostly get inflation under control as long as it doesn't get away on them again. So we've seen the number of CEOs talking inflation coming back down. Also CEOs talking about recession coming back down. That's generally a reasonably positive sign that this worry that we had a year ago of stagflation might be going away and you might have a soft landing and perhaps a decent economy along the way. The fear has been that the central banks would have to engineer a recession to tame inflation like they did back in the 80s. So far, they've been somewhat successful. This is the FOMC member forecast for September relative to June. And I know it's hard to read. The most important parts are over here on the left-hand side, so I'm just going to note them here. For the Fed funds, they maintained probably an expectation of one more hike this year. For 2024, Fed members in June had forecast about 1% of rate cuts. They've cut that back to 0.5% of rate cuts forecast for next year. That's that keeping rates higher for longer. And then 2025 was basically the same rate cuts just coming down from a higher level based on the fact that of fewer cuts in 2024. So, and then 2026 they expect continued rate cuts. So they're kind of pushing out the rate cuts may come eventually, but the Fed's kind of pushing them out. Meanwhile, their inflation forecasts were pretty much unchanged, and the encouraging part was the GDP forecast actually had quite an uptick for this year. They moved it up to 2.1% from 1.0 in June, and they moved 24 up to 1.5% from 1.1%. So that's an encouraging sign for the economy and the business environment. But overall, what we're seeing in the markets is they focused more on the expectation of fewer rate cuts in 2024 means tightening for longer, and that is served to boost treasury yields, have a negative impact on bonds, weigh on stock markets, and weigh on commodities. So and other currencies. So anything priced in US dollars has been taking a hit more recently, and eventually that can adjust itself and work its way through. What's important, and we haven't looked at this slide in a few months, but I thought I'd bring it back since it looks like we're getting close to the end of the current interest rate hiking cycle, is, and it's an interesting one too, with the Fed talking about fewer cuts, is that sometimes it's a be careful what you wish for thing, because when you've had interest rates peak and start to drop off in the past, has been followed by a bear market, because usually interest rate cuts are also often associated with a weakening economy. So we saw in 1999 to 02, the Dow fell 27%. In 07 to 09, the Dow lost 50%. Even December 19 to 20, the Dow lost 23% in a very short period of time. And although we didn't have rate cuts, we can see that this 20 to 25% bear market is not uncommon, because even in 2022, the bear we had, even though Fed funds hadn't peaked, we still saw a 20% bear market. So we want to be careful here as well of the, yes, it means the Fed staying higher for longer is not a bad thing, but if the Fed doesn't have to cut rates, it's also a sign of a stronger economy, and that can be good for corporate earnings. So there's a few different ways to look at this. There's a short-term reaction, and then there's potentially the longer-term reconsideration. Seasonality has been interesting this year. We saw that in 2022, which is the red bars, was quite a volatile year for seasonality, and I'll just look like July, August, September had significant declines, and then there was a big rebound in October of 2022. This year, what we've seen so far is we have seen seasonal weakness in the markets. The green bars are the Dow, the purple bars are the S&P. So we have seen typical July strength, but was not as strong as July of 22. August and September to date, we've seen some weakness in the market, but not as much as last year. So then we look for October and we think, well, so October historically you do get a bounce, but if you haven't gone down as much, maybe you don't rebound as much. We'll see what happens. But this year generally seems to be a little bit less volatile year than what we saw last year, even though the seasonality swings are still there. So now I'm going to look at capital flows and relative performance in the market through a tool that is on SIA charts called the sector scopes. And this measures the percentage of stocks in 31 industry groups that are on a bullish signal. And the higher percentages are on the right, the lower percentages are on the left. So what this here tells us, this was in the middle of July, majority of the sectors were kind of piling up at the extreme right-hand side. So this meant you were kind of in a bullish market, but also getting a little bit overbought. As we moved into August, we can see that there was a leftward shift. So the percentage of stocks on bullish signals was dropping and across a number of sectors. But we ended up here with this wide distribution across the spectrum. This is kind of a normalized market. So it wasn't as overbought. So you had a bit of a pullback or correction. And but now as we've moved into September, we can see we're still seeing a leftward shift. So this is more indicative of a market that is coming down, but the two leftmost columns are empty. So even though the market is drifting downward, it's not oversold. We haven't seen this extreme drop-offs either. It's more of a mixed, almost a stock pickers kind of market here. And so what are we seeing that's showing stronger performance? Well, we're still seeing that resource sectors, energy, metals in particular. Insurance actually has been particularly strong as well. On the weaker side, we're seeing consumer staples, tobacco, so defensive names. Transports have been hit hard. I talked a little bit about the airlines, but with rising energy costs means higher fuel costs for transportation companies, and they've been taking a hit on that. Healthcare, some of the defensives, food, some interest sensitive names like real estate, auto sector, which has been getting hit by strikes, semiconductors, computer hardware, higher beta groups that have been hit in the market correction as well. And so here, if we looked at the U.S. sector, so I'm looking, these are ranked by their 3-month return to September the 18th. So the best performing sector over the summer by far was energy, and I will speak to energy a little later in this presentation. Materials, financials also did well. The weakest sectors, healthcare, communications, as I mentioned, so tech communications were hit in a correction because they had quite a strong start to the year, and you can see at the year-to-date number that technology is actually, and industrials are still the highest performing groups over the entire year to date. So the tech in particular had a great start to the year, and then of course it had a larger correction. Utilities is the weakest sector year to date, and that seems to be a function of it being more sensitive to interest rates and some more similar to bonds, although in the last month utilities have actually had a bit of a trading bounce. Now we're looking at so what is happening with different levels in the market. So we're looking here at what's happening with big caps, mid caps, small caps. So the orange is the S&P 100. Big caps are still outperforming over the course of the last year. The gray line's the S&P 500. Purple is the mid caps have started to trail off, as has the Russell 2000, the small caps. So the big caps have held up recently, but the smaller caps have started to roll over. That's a sign of investors losing confidence, less willing to hold smaller companies. Those seem to be getting dumped overboard first. I've talked about interest sensitive groups. So this looks at banks and real estate and utilities and bonds. And so fixed income bonds have tailed off since July. That's the brownish line. That's the TLT ETF. We've seen over the course that the banks had sold off, which is the orange line. It sold off back in the spring. They had a rally into about August, and they've been tailing off again lately as well. Utilities have just generally been quietly drifting lower. That's the green line. And the purple line, which is real estate, has been actually kind of holding steady of late. Now, I mentioned energy and materials. So we're looking here at material. This is a 1-year chart, and what it's showing us is, let's start with the purple line, which is energy stocks. You can see we're kind of drifting through much of the year. They've taken off this summer along with oil prices. The orange line is the basic materials ETF, is basically in line with the market these days. Steelmakers, which is the green line, have done particularly well. They rallied in the summer and have held on to their gains. But the agriculture, the food part, they have been drifting downward. That has underperformed other material areas. grain prices have not done very well, and they've been breaking down lately as well. So that's one area, surprisingly, with the food and agriculture prices, that those prices have come down, yet grocery prices have not. And that seems to be now becoming more of a political issue. So Dow Jones, we like to look and compare the industrials versus the transports versus the utilities. So the industrials over the last year have been more or less in line with the market. They outperform a bit, they underperform a bit, but they're overall kind of in line. The transports were very strong, but have weakened over the last month and a half. So that's something to keep an eye on. The utilities have just been struggling throughout the year. Growth versus value, this is a 3-year chart, and we can see in 2021 and into early 22, growth and value were doing pretty well, mostly in line with the market. In 2022, value held up a little better than the market did, and certainly relative to growth stocks. More recently, we have seen since the beginning of this year, both growth and value picking up. Value is, and we can see it in the Dow Industrials, we can see it in energy, we can see it in industrials. Value has actually been holding up relatively well in this market environment, even though the growth stocks tend to get most of the headlines and attention from the media. This is looking more globally at US versus Canadian and international equities. So the gray line, of course, is the S&P 500. The purple line is the ex-US developed markets, had been outperforming through most of the year, has kind of started to tail off a little bit more in the last couple of months, as has the green, which is the emerging markets. So markets outside of North America are starting to weaken a little bit. Well, we're keeping an eye on that, and that's both emerging and developed markets. The orange line, which is Canada, has actually started to pick up in the last month or so with its higher weighting in the energy and material sectors. Looking at crude oil here, this chart shows us that this is a long-term, about a 12-year chart, shows us the sell-off in 2014, the sell-off in 2020, the rebound 2020 to 22. There was a decline in the second half of last year and the first part of this year. It had stabilized over into the summer, and now we're seeing a breakout by crude oil. That breakout up over about 83.50 signaled the start of a new upswing, which recently carried crude up above 90. It's come back off a little bit in what so far looks like a trading correction, but at the moment, crude oil does look like it seems to be wanting to turn back upward. And what's interesting about this is we've looked at this chart of oil and oil stocks before, where generally energy prices and energy stocks are what we like to refer to as fellow travelers. They tend to trend in the same direction. When oil came down in late 22 and early 23, the energy stocks held up. But what's interesting, if we look at May, June, July, energy stocks started to pick up again ahead of energy prices, with that one exception where they didn't. For the most part, energy stocks tend to lead energy prices, and the reason for this is that implicit within any earnings estimate for an energy company is a forecast for energy prices and a forecast for production volumes. So therefore, at any time, the stock prices of oil and gas producers are inherently including a forecast for the future direction of energy prices. The other really interesting thing we saw in over the course of this summer was in the other energy area, of which there's two main areas. There's the alternative energy areas, which we've included here in the green and purple lines, a solar ETF and a clean energy ETF, so solar, wind, etc. And then there's energy, which is nuclear power. Uranium, which is nuclear power, related to nuclear power. And what's interesting with this is since May, the uranium price and uranium stocks have taken off, and other alternative energy has absolutely collapsed. And what it would seem to me is that investors seem to be deciding that in this alternative energy race, that uranium is most likely to win. And if you think about it, it makes sense, because if we're going to move from fossil burning fuels to alternative energy cars and battery and so on, that you are going to need a lot more baseload power in your electric grid. And the only way you're going to be able to build that much baseload power into your electric grid is through nuclear power. and we look at places, and we've seen that overseas there's a lot of nuclear plants being developed, and in Ontario even, who has the world's largest nuclear facility, are talking about expanding it. And in the States, they're probably heading that way too, is that eventually to meet the climate change goals is probably going to require a lot more nuclear power to increase the base load of your grid, of your electric grid. And that is why we're now, and that seems to become more apparent over the summer. And that looks to me like what the market is trying to tell us here. One last slide, and I call this a bonus slide because it doesn't really fit anywhere else, but it was just something I thought was interesting and intriguing. And I talked earlier about from various FactSet reports on what CEOs were talking about during the earnings calls of the summer quarter. And so I focused initially on recession and inflation, but these were a couple of other things that came out. Was they had published one looking at alternative. What else are they talking about? Well, it seems that artificial intelligence is a big one. AI on this left-hand slide was fairly moderate in the last 3 quarters, has taken off and become a real topic of conversation. On the other hand, ESG has come down as a topic of conversation, something that's less important, less top of mind for executives. So this is just something that's interesting in terms of business trends, and something to keep an eye on as we move forward. SIA Wealth Management is a sub-advisor for several funds that are distributed by BMO Global Asset Management. And on this slide here, we featured the symbols and the names, of course, of the 5 major funds, 2 of which are also available as exchange-traded funds. And finally, this is our disclaimer slide. We'll wrap up here. I'd like to thank you all very much for joining us this month, and of course we will be back in October with our next market outlook. So we hope you have a great day, and thank you very much again for joining us.